This is David Ranson. Welcome to HCWE's client webcast for the month of May 2021. It's on a theme: what the pandemic experience is telling us about extreme fiscal policy. Looking back at the pandemic, many will ask why some countries were more economically vulnerable than others. Was it a matter of the differing policies they followed to combat the virus? Equally interesting, why was it that some countries had stronger rebounds than others? The general assumption is that it's the scale of the fiscal and monetary policies used in response to the crisis. The pandemic of 2020 offers a chance in a lifetime to measure the effectiveness of the extreme fiscal or monetary policies advertised as stimulus programs. That's because different countries had different reactions to the pandemic and different degrees of rebound. The scale of their fiscal and monetary actions also varied enormously. From these data, it's possible to determine whether more generous stimulus promotes more vigorous recovery or not. There's a simple explanation for why some were stronger and others weaker, and it's not stimulus. This webcast focuses on fiscal policy, that is, simply the raising and expenditure of tax revenue. It has always been the chief means by which the executive branch of government seeks to manage and shape the economy. But different varieties of fiscal policy may have different effects. The chief categories are listed in Exhibit 1. To keep it simple, we look at the two broadest divisions of fiscal policy: transfer payments and purchases of goods and services. Transfer payments include unemployment compensation and disaster relief payments. Government purchases are what the government consumes and invests. That includes defense spending, the cost of running the civil service, and infrastructure spending, like President Biden's proposal that is currently under consideration by Congress. Measuring the effect of any of these on the economy turns out to be quite a challenge. We begin with the large-scale pandemic relief actions initiated by the Trump and Biden administrations. Although US recovery followed aggressive actions by Washington, it's not easy to tell how much impact they had. Both fiscal and monetary stimulus grew most rapidly, just as the economy was tumbling to its bottom. And in the second half of the year, the economic recovery maintained its momentum after benefit programs enacted in the spring expired, and Fed efforts paused. A decline in federal outlays followed, because the parties were unable to agree on further stimulus packages until after the election. Despite that, retail sales and employment both continued their advance. As is always the case, the speed with which the consumer spending climbed back dwarfed that of employment. As Exhibit 2 shows, economic performance and the flow of government relief payments were related to each other, but inversely. This correlation is best explained by causation running from economic performance to government action. In recession after recession, the economy's downturn has triggered an increase in fiscal benefits. And when the economy recovers, relief payments drop back. So, if there was a causal and positive connection running from fiscal policy to the economy, it was late to appear and weak enough to be invisible. Most people do believe in a positive effect, but proving or disproving that is no mean task. If we can't draw conclusions from time series evidence, maybe we can do better with cross-sectional evidence. Across the world, fiscal policy has been conducted on the largest scale ever, but differently in different countries. We begin with Exhibit 3. Which is derived from a handy chart published by the Wall Street Journal last November. It shows how economies around the world tumbled early in the year and then rebounded. Although some governments enacted much more stimulus than others, the vigour of these recoveries was impressive everywhere. Fiscal stimulus efforts ranged in scale between over 10% of GDP in the United States to 2% in China. With less than half the effort relative to the size of their economies, France and Spain had much larger rebounds than the US. And with less than 1/5 of the US effort, China's 2020 rebound was also larger. All in all, it's the worst hit countries that had the strongest rebounds. So the international evidence seems to cast some doubt on the effectiveness of extreme fiscal policy. More comprehensive and up-to-date figures appear in Exhibit 4. I include the IMF's estimates of the scale of fiscal stimulus for the G20 countries. Russia's omitted because GDP data were late to arrive. The stimulus numbers distinguish between the two different types of transfer payments. In Washington, the pandemic has brought a major shift in the targeting of transfer payments to beneficiaries. Instead of the traditional focus on recapitalizing the business sector, cash is now sent directly to individuals and households. However, Germany, France, and Britain, for example, stayed mainly with the traditional approach. The division between these two categories of transfer payments varies from country to country, as the exhibit shows. Economies are ranked vertically by the vigour of their rebounds, the green bars. Each is measured by real GDP growth in the second half of 2020, except for China, which rebounded 3 months earlier. On the right of the chart, stimulus estimates are given for each country. It's hard to see a connection between the scale of either variety of fiscal policy and the vigour of a recovery. But the US and Australia, whose cash transfers were the most generous, had relatively weak rebounds, as did Germany, whose business spending was highest. India, which had by far the largest rebound in 2020, spent little on pandemic relief in either respect. How fiscal policy relates to economic recovery is easier to see in Exhibit 5. The size of each country's rebound is plotted vertically, and the scale of its transfer payments is plotted horizontally. The two panels cover the two flavours of fiscal policy separately. Although the scatter is wide, the slope of each of the least squares lines is not positive, as might be expected, but negative. The correlations between strength of rebound and fiscal stimulus are minus 0.42 in the case of spending and revenue measures, and minus 0.05 for loans, equity, and guarantees. The first is statistically significant at about the 5% level of confidence, while the latter, the second, is insignificant. How to explain this apparent inability of fiscal policy to speed economic recovery? There's a broad economic principle involved concerning the economic response of those who receive unusual income, such as a windfall or an insurance payment. It's well established that recipients of such income mostly save it rather than spend it. Saving includes not only abstention from consumption, but also the paying down of debt. Recipients of pandemic relief payments who don't spend the income are not promoting recovery. The principle involved was advanced by Chicago School economist Milton Friedman, who was awarded a Nobel Prize for it in 1976. It's known as the permanent income hypothesis. Friedman theorized that spending is proportionate to the sustained or permanent portion of a consumer's income rather than the transitory portion. It implies that any unusual income will be largely saved or used to pay down debt. Transitory income would include income in any form paid out for the purpose of kickstarting the economy. Most of it will not be spent, and it will not, for example, motivate an increase in capital investment. Exhibit 6 shows that the pandemic experience has been no exception. In the left panel, the US personal saving rate jumped from a normal 7% in the first quarter of 2020 to over 30% in the second quarter, as the economy plunged and large-scale fiscal stimulus began. In the third quarter, the scale of relief payments fell and the saving rate came down. After the election, when another stimulus bill was passed, there was a second spike in the saving rate. And now a third is underway as a result of further stimulus urged by President Biden. None of these spikes in saving have a discernible effect on the performance of capital investment as a percentage of GDP, which is shown in the right panel. It turns out, therefore, that something other than fiscal policy explains the speed of recovery, domestically or overseas, and that is natural resilience. This simple explanation must be the decisive factor, and it is amply demonstrated in the international data in Exhibit 7. The red bars rank the GDP setback in each country in the first 2 quarters of its pandemic experience. The green bars show how each economy grew in the second 2 quarters. The overall relationship between downturns and rebounds is close. Only China, Turkey, and India stand out as exceptional. The rebounds in China and Turkey actually exceeded the preceding downturns, while India's recovery exactly matched its slump. But it's impossible to miss the pattern, whereby the more severe the setback, the more impressive the recovery. The vigour of rebound appears to reflect a natural propensity to snap back from adversity in an automatic and mechanical way. It's not a function of government efforts to boost economic recovery. The resilience of economies in the face of natural disasters is no secret, though in the United States it received little publicity during the pandemic until the evidence could no longer be ignored. As long ago as 1964, Milton Friedman formalized this phenomenon in a theory he called the Plucking model. That's the idea that economic fluctuations in general are explainable as downturns, which are automatically followed by snapbacks, returning the economy to the status quo. His evidence argued against the standard view still prevalent today, whereby periods of growth create the conditions for downturns. Exhibit 8 quotes what Friedman himself said, along with more recent supporting comments. As Noah Smith puts it at the top of the page, the deeper the recession, the faster the recovery that follows. Friedman's Plucking model stresses the natural adaptive ability of a market economy. Neither the capacity to restore normality nor the incentive is harmed by a production hiccup. If output cannot be produced in one time period, it will be produced in another. Economic health will be redistributed among sectors. There'll be an output dip, but no more than that. This is the basis for the picture of the economy's reaction to pandemic fears and shutdowns shown in Exhibit 9. It's a chart we originally published in March of 2020. It illustrates the shape of the economy's path when it collides with a temporary obstacle such as a major strike or production shutdown. In the process, much time is lost, and there are human costs from reshuffling the economy and labour force. But as long as no capital is destroyed, and the will to keep capital at work is not depressed, GDP is free to bounce back to its prior trajectory after the obstacle is lifted. Exhibit 10 shows the quarterly behaviour of real GDP over the past few years. We are now in a position to judge whether events have vindicated the theoretical paradigm in the last exhibit. They clearly have. The fit is excellent. Today's policymakers are unlikely to accept that the economy doesn't benefit from government stimulus, but if they did accept it, what should they do? The answer must recognize that fiscal relief has some humanitarian justification, even if it fails to stimulate. But what the economy needs most is to be left free to heal itself rather than be distracted by unsubstantiated medicines. Public policy should promote resilience and not dependence. Exhibit 11 plots the international relationship between pandemic downturns and snapbacks in detail. The correlation is minus 0.86 and extremely significant statistically. It's a remarkable straight line relationship in which the slope of the least squares line is very close to minus 1. And it is, of course, a powerful demonstration of Friedman's Plucking model in action. These provisional findings can be double-checked by letting the stimulus and resilience variables compete statistically to explain the vigor of rebounds. This can be done by least squares calculations, but the results can be more simply summarized in a chart. Exhibit 12 divides the 19 countries into 4 subsamples and looks at their fiscal, revenue and spending efforts. The subsamples are defined according to whether stimulus was above or below average, and according to whether the depth of the pandemic downturn was above or below average. As already demonstrated, rebounds are primarily explained by resilience, but it's now also clear that this kind of fiscal stimulus, direct cash to the population, tends to be counterproductive. Exhibit 13 repeats the exercise, looking instead at fiscal policy in the form of loans, guarantees, and equity investment. The result is pretty much the same as for cash payments. When the symmetry of rebounds and downturns is taken into account, the effect of financial support to business is also counterproductive. So, both forms of fiscal stimulus tend to be bearish. The newest chapter in US fiscal policy is President Biden's infrastructure bill, which is dividing Congress along party lines. This requires us to shift our attention from transfer payments to purchases of goods and services. Here, too, it's usually taken for granted that government action stimulates the economy. The famous multiplier is the presumed gain in total GDP generated by $1 of federal purchases. There is wide disagreement about its size. We have an annual history of the federal government's consumption and investment spending data going back to 1929. Exhibit 14 is designed to show its effect on the private sector and hence the total economy. Spending data are expressed as a ratio to total GDP so as to preserve comparability among years widely separated in time. The chart distinguishes increases and cuts in federal purchases, large or small. The largest are associated with the transition from peace to war at the beginning of the Second World War, and the transition from war to peace, demobilization beginning in 1945. We see that the private sector response, measured over a 2-year period, is opposite, consistent, and roughly proportionate. This result supports 2 classical insights. Thanks to the economy's resource constraints, federal purchases divert resources from private sector use. Such an inverse relationship between federal and private purchases has long been known as crowding out. There is even more than a one-for-one trade-off between federal spending and the private sector response. Evidently, the economic results of political choices through the federal purchases are productively inferior to the choices made by private business. The original Keynesian view was that the economy's resource constraints are effective at full employment. So the potency of government spending shows up only when the economy is depressed. Deficit spending ought therefore to be confined to periods in which unemployment is high. And this is still conventional wisdom in Washington, although it is not always followed in practice. But how much difference unemployment actually makes can be estimated from the data in the last exhibit. In Exhibit 15, the history is divided into 4 20-year subsamples, and the inverse private sector correlation is compared in each. Surprisingly enough, it is not systematically weaker when unemployment is low than when it is high. It appears that crowding out occurs regardless of the unemployment rate. Once again, the evidence does not support the case that fiscal policy is stimulative. And here is some reading, including papers written by us at HCWE and some others on these topics. That's the presentation, and thank you for listening. We look forward to having another webcast in July, and I'll talk to you again then. Thank you.